So GSV Capital is a publicly traded fund on NASDAQ that invests in the most dynamic, fastest growing VC-backed private companies in the world. So our largest investment is Twitter, where we have approximately $35 million invested, but we're investor in Dropbox and Spotify and Palantir and a number of the most exciting growth companies in the world. Well, Silicon Valley is a very fertile environment to find great small companies that have huge potential. It's a magnet for talent. It's a magnet for the ecosystem that supports ideas. And so we find probably 80% of our investments are between San Francisco and San Jose, which effectively is the Silicon Valley. But the name of our firm, GSV, stands for Global Silicon Valley. And so here we're looking to expand that to where the mindset that's created this incredible environment in Silicon Valley is really going viral around the world. So we say we're looking for the greatest opportunities from Austin to Boston, from Chicago to Sao Paulo, from Mumbai to Shanghai to Dubai. That's what we're looking for. Yeah, Brazil is one of the most exciting and impressive emerging economies in the world. Obviously it's the prominent member of the BRICS. But I think importantly, what you're seeing is South America as a continent is really coming into its own. Clearly, the Olympics and the World Cup bring global prominence to Brazil. But what we see from just an opportunity standpoint, we're starting to see incredible opportunities are being developed in that market. So we have a significant interest in Brazil and looking forward to being more and more involved. Well, I think first and foremost what a startup needs to do is to have a clear vision and a mission of who they are and where they're going. A lot of entrepreneurs think that what you're supposed to do is tell the investor whatever they want to hear, but most investors, what they're really looking for is an entrepreneur that has a passion and vision that wants to do something dynamic and change the world, often an idea that completely is different than what the investors even heard of before. Sure. And so I think that's the foundation. And then I think the other piece is you want to bring a team together that shares that vision. It's tough enough to start a business with one plan than to have several plans and a culture that's diverse. You want people to be on the same page, on the bus, and go to the same destination. One of the biggest, and that's natural, is they try to get the highest valuation for their idea. And often that causes a couple different issues. One, the investors that may be able to help you grow the business the best might be turned off by trying to seek that very top dollar. Secondly, when you get a high valuation sometimes, it causes bigger problems if your business doesn't develop as fast as what you promised investors. And that again can cause some real issues. And so I think, what you want as an entrepreneur, I believe, is to get a fair valuation, but with the best investors you can find, because they're the ones that are going to help take this idea and really bring it to life and create the significance. Well, we have a framework that we've developed over a number of years, and it's really meant to identify, invest in what I call the stars of tomorrow, which are the fastest growing, most innovative companies in the world. And so the formula that we use is, first and foremost, we look at where's the most interesting opportunities likely to be created. So we look at mega trends, globalization, internet, demographics, mobile, all these different kind of mega trends, and think how those are impacting the growth sectors of the economy, because 90% of the most interesting ideas will be created around that kind of intersection of mega trends and industry. But then we look for, very specifically, companies that possess what I call the 4 Ps. And the first P is the most important P, and that's the people. There's no shortage of interesting ideas, but it's always the people and the execution against that idea that make the difference. And so many of these management teams don't have long histories, but the person has a history. And so we're looking to back winners and management that truly has the vision and the drive to kind of do what you need to do as a startup to make things happen. Second P we look for is product. Here we're looking for a company that lead an industry, have the opportunity to lead an industry, have a proprietary product, or better yet, a one-of-a-kind company, something that's never been done before. The third P is potential. How big an opportunity is this? What are the mega trends that play to this opportunity? Often, big potential companies are solving an enormous problem. The bigger the problem, the bigger the opportunity. And the fourth P is predictability. How visible a business model is this? What kind of operating leverage does it get with scale? Obviously, a startup business has no visibility, but thinking about the business model and how the entrepreneur is going to develop the business, we like to see where there's a path to creating that visibility and predictability. Well, it's incredibly important, in my view, to have an extremely open mind, because often the ideas that turn out to be the best seem the most ridiculous at first. And so having an open mind to thinking about what the business opportunity is and what this entrepreneur is trying to solve and who this person is important. So you have to cast a pretty big net so you're not missing something just because it seems impractical. But then you have to rapidly be able to narrow that down into this framework. So there's no way that you can personally analyze 3,000 companies a year. But you should have if there's 300 days that you can see people, you should basically have as many meetings as practically you can, because again, that's really the start of a process. But then we get it down to maybe 150 companies that we do pretty significant analysis of, and then we've been averaging making something of the order of 20 to 25 investments a year. Yeah, so there's 5 themes that we feel are the most fertile, for us to focus on.
Right.
That doesn't mean, and so that's another kind of way that we like to kind of filter through, the thousands of ideas that are basically out there. Those 5 themes are social mobile. We believe strongly about the power of social media and the fact that you're still going to see a number of social media businesses that are wildly successful, and obviously mobile is where it's all at right now. Sure. And so that's a very important theme. Big data and cloud computing is a second major theme that we're focused on. A third is internet commerce and services. A fourth is sustainability and green technology. And the fifth is education technology. And so those are really the 5 core themes that we're focused on. Probably 90% of our investments will fit within those 5 core themes. Well, for us, we're looking to create what I call a vertical knowledge stack. In fact, I write a weekly column that's called A to Apple. And what that really stands for is we're looking at businesses from the A round to Apple, which is the largest growth company in the world, and everything in between. Now, typically, true startups or seed round investments, we're not going to participate in. But we've participated in A round, B round, C round, D round companies that are public with 2 funds. I described GSV Capital. We also have a hedge fund that invests in public companies. Yeah, so valuation matters because you have to have a discipline around the price you're going to pay versus what the opportunity is and what's the risk involved. That said, I think the biggest mistakes I'll say I've made, and I think many growth investors have made, is being too precise on a price of a great company and a great entrepreneur. What you've seen over and over again is a company that seemed to be, too highly priced, that became, a mega home run because the entrepreneur was able to build that business. Facebook, when they did their $80 million round that was funded by Excel, or 80 million value, everybody thought Excel was crazy. Facebook had 0 revenue, so forth. Well, it returned Excel $1 billion, so it worked out okay for them. And the reality is, if you really find a company with those 4 Ps, as long as you pay a reasonable price, that's more important than a company that doesn't have those characteristics and getting a bargain. So our time horizon is philosophically much longer than the typical investor. And the reason for that, if we find a truly exceptional growth company that can grow for a long time, we want to basically, ride that growth for as long as possible. What I've said, when you really find these special companies, a Twitter, a Dropbox, I think, avenues. There's a number of, Spotify, and it might seem a little expensive, vis-a-vis kind of where the revenues are at or where the business model's at. But when you really find that special company, the best thing to do often is, take a deep breath, close your eyes, and hold on for the ride. So, the typical mortality rate for startups is extraordinarily high. And so what you're doing is, and again, as you kind of go along the stage curve, it becomes less so. But if you're a good startup investor and only 50% of the companies fail, you've done really well. And I think that's a mindset that people need to understand. You're not going to invest in startups and have 100% batting average, or not even typically have companies that go away very quickly. There's an old adage in the venture community that your lemons ripen fastest, right? And so you see that, you have this J curve where you see the startup failure to be quite high. And I think one of the reasons why Silicon Valley is special is because that's a well understood reality here. That people don't look at failure as being like, oh my God, you got to quit. It's basically, this is part of the whole entrepreneurial reality. And you have to be able to see that failure is actually going to lead to the next success, and you can't get gun shy by that. So the fund, as I mentioned before, is a publicly traded fund, and so in private companies. So the real measure of the return, the stock price since the beginning of the year is probably up 15% or so. What's going to really make the difference, though, is what is the portfolio return, and we're only going to really be able to quantify that over 3, 5, 6 year period. Our public fund that invests in public companies is actually up 40% year to date, and so we're pleased with that, and we're very pleased with the underlying fundamentals of our private fund, which the portfolio of companies has revenue growth year over year of over 80%. Yeah, I think the greatest advice I can give them is, stay tuned to the cashing in, because I think you're onto something. I think the focus that you have and the tools and resources and insight that you're going to provide is going to be very valuable for these entrepreneurs. The second bit of advice I'd give is, don't let anybody tell you that you can't succeed or why you can't do something. Entrepreneurs are great at doing things that conventional wisdom say are impossible, and that's what makes them great entrepreneurs. Okay, well, this is a book I wrote called Finding the Next Starbucks, which the publisher was the one that gave it the title, and it was because I was the first person to identify and recommend buying Starbucks stock in 1992.
Wow.
So that was a great company to be involved with early. And there was a great example of the CEO, Howard Schultz, being a very special guy with a very clear vision and passion, where a lot of people said it was crazy that you're going to create this national, now global network of coffee bars.
Very good.
Thank you.
I will read it. I will read it.